Hi, good evening. A very warm welcome to all of your friends for joining me in this quarterly webinar. And since we are still early days into the new year, let me take this opportunity to wish all of you all a very happy new year and a very happy festival season with Pongal and Sankranti. So let me quickly begin by sharing my thoughts in terms of how I'm thinking about we at Renaissance are thinking about markets and what's the outlook for the year going forward, and I'll also touch upon how our portfolios are positioned to in the context of where we are in this economic cycle and our outlook for markets. Yeah. So with that, just to give you a broad summary, friends, if you see last year has been a moderate year from an equity market perspective. We've seen Nifty 50 on a full year basis in calendar year 25 has done about 10.5% returns. So that is now second year of moderate returns, successive year of moderate returns at Nifty 50 level. But yet we've seen significant moderation in returns in the mid and small cap. So the small cap index actually gave negative returns and the mid cap index returns were lower than the large cap index. Now, if you see, we are 5 years into this 6 years into this bull market. The last 5-year returns in this bull market out of the outside of the COVID, this thing, if you see large cap, the Nifty 50 has done about 13.3% CAGR, which is pretty much in line with long-term returns of Nifty over the last 20 years. So, which also effectively means that as far as Nifty is concerned, returns are pretty normalized, and we find a lot of valuation comfort in the large cap companies going forward. I'll talk a bit more about that as we go along. Obviously, mid and small cap in the first 5 years of the bull market tend to give high returns, and which is where the excess returns have been in the last 5 years in the mid and small cap. We've seen some moderation happening during the course of last year. And our view going forward, my view for this year as well, because I get this question asked very often. So let me state this upfront. I believe that this year is going to be similar to the last year, where we will see large caps will outperform mid and small caps, and mid caps will outperform small cap. So something what happened last year might continue to happen this year, because valuations in mid and small cap are, even today as we speak, are much higher than large cap, and that valuation convergence or narrowing of the gap will continue during the course of this year. Having said that, maybe let me quickly highlight some of the key highlights that we are observing in the market. One big story of the market so now has been that last year was the second successive year where we've seen continuation of significant new supply coming into the equity market, new supply of paper coming and hitting the equity markets. Across all the new supply that has come to the equity markets, across IPOs, OFS, promoters selling or private equity funds selling, and QIPs, we've seen aggregate $58 billion coming into new supply coming into the markets in last year CY25, and more importantly, over the last 2 years, aggregate supply is now as high as $130 billion. And this is like the really highest level of supply of new paper that I have seen in the history of this markets. And on top of that, we've seen foreigners selling almost about close to $20 billion last year. So that's, that puts the total supply of paper coming from new supply and from institutional investors, foreign institutional investors, to $150 billion taken together. Obviously, a large part of that supply has been absorbed by domestic investors. So the story of Indian equity markets has been the very strong inflows or the sustained inflows that we continue to see into domestic mutual funds and domestic participation by domestic investors, which has absorbed this supply to a large extent. Effectively about $90 odd billion or 60% of the supply has been absorbed by domestic mutual funds, and another $40 odd billion has been taken up by insurance companies and financial institutions in India. So about $130 billion has been absorbed between domestic institutional investors. So I think that's the story, and whilst we are still early into this year, but in the 2 weeks of this year, foreigners have continued to sell into India. So looks like at least in the first half of the year, we might see continuation of foreign flows, outflows in India for reasons that we'll discuss going forward. But I thought I'll highlight this, and the supply of paper is really something which slightly from now that we're getting to the third year of this cycle, and the kind of IPO pipeline supply that I see is very significant. That is there. I think this year, if market holds, will be another similar year where we'll see about 60 to 70 billion dollars of supply, new paper supply coming into equity markets, and we have some very large IPOs, or offerings lined up during the course of this year. So I think this story continues where, and as a consequence, it works both ways. So it's both a positive and negative. It's a positive because we get a lot of good quality companies coming to the markets and investors getting to participate into that. We've seen that happen last year, companies like LG Electronics or Grow and so many other good companies. And this year also we have a lot of large IPOs lined up, likes of PhonePe, Flipkart, Jio Telecom, and many more. So it does give investors to opportunity to participate in some of the best companies in India. But at the same time, it does put an upper cap on markets in terms of market performance, because this supplies does suck out significant amount of liquidity and flows from which otherwise would have gone to the secondary market. But that is the nature of the markets. That is how markets behave. So I think we should be prepared for a very large supply of paper and some upside, which will put cap on valuations or on the momentum of the market going forward, which is why one of the reasons I think the returns this year will be positive in the index or markets, but it still be moderate to that extent, capped by supply of paper. Having said that, the performance of these IPO companies has been somewhat mixed. India now at $20 billion of IPO fundraise that India has witnessed in the last 2 successive years is now the fourth largest capital raising capital provider in the world. The third largest rather capital raising in the IPO in the world is happening into Indian equity markets. That clearly tells us that Indian markets have come of age and have clearly matured and have achieved some critical size, that it's become the third largest fundraiser in the primary markets. Having said that, 1 year post listing, if you look at the performance of companies that have got IPO'd, the performance is somewhat mixed. About 50% of the companies have given negative returns 1 year post listing, and the average returns of all the companies taken together, or the median return from IPOs 1 year post listing, is just about 4%. So there's a very wide dispersion in performance of companies 1 year post listing when I look at IPO companies, and which is why I always say that it's very important that investors should be very careful in analyzing these companies before putting their money or participating into IPOs. Somehow we have felt concerned because we find valuation in most of the IPO companies pretty expensive, and as a consequence, we at Renaissance has stayed away from the IPO market for almost last 18 months. We have done 0 IPOs, or we have not participated into any IPOs because we find more companies which much more longer track record, and at more reasonable valuations in already listed secondary markets. And we don't believe in flipping, or we don't take short-term view on companies. So we don't believe in flipping by buying into IPOs and just making short-term gains by trying to flip those companies. We don't play that game. So as a consequence, we have stayed away from the IPOs. One interesting that happened, friends, in the last quarter, in the October-December quarter of 2025, is a significantly high amount of interest that has emerged in India's financial sector from global investors. And these are very long-term investors. Some of them are very strategic investors. They are not financial investors. They are taking a strategic view on India's financial sector. And some of them are private equity investors, but taking a very long-term view again here. India's financial sector has seen aggregate about $12 billion of long-term money in terms of FDI coming into across 7 or 8 large names with large stakes being taken or investment being made. And this clearly reflects the one very strong growth outlook for financial sector in India over the next 10 years and 20 years, and the very strong interest that foreigners have in investing into India's financial sector. And also reflects in the fact that in fact financials is one of our biggest exposure in our Renaissance portfolios, and we feel equally optimistic and sanguine about the growth prospects of financial sector over the next decade as India navigates this journey of getting to about $10 trillion of economic size from where we are currently. I think there's immense amount of value or wealth to be created out of financial sector in India, given still very low penetration of financial services across the board or across the spectrum in India. So clearly we feel pretty excited about the long-term growth prospects of financial sector in India, and it's reflected in all our portfolios, with financials being the largest exposure in our portfolios. Another thing I want to really highlight is what is really at the center of equity markets globally has been this AI trade or AI investments. In the last 18 months, over 80% of equity money globally has gone into AI companies or companies which are part of the AI ecosystem. It's been now over 3 years since the first AI model was launched. ChatGPT-1 was launched in November 22. Over the last 3 years, significant investments has been made in AI infrastructure across the semiconductor companies, likes of NVIDIA, TSMC, SK Hynix, Samsung. Significant amount of investments have also been made by the hyperscalers who are setting up cloud infrastructure and scaling their cloud infrastructure at a very rapid pace in terms of setting up data centers. So, and which can be used by the AI companies or the foundation model companies to run their models or inferencing. And obviously, at the forefront of this AI revolution is the LLM companies, the likes of OpenAI, Anthropic, Claude, and so on and so forth. To the extent that now, if you look at the top 7 companies in US, as they are called the Magnificent Seven, they constitute about 34% of S&P 500. This is once again the highest level of concentration that one has ever seen in the history of US markets or global markets as well, in the US context, because the highest concentration prior to this was in 2000, during the 2000 dot-com bubble. But even then, the top 7 companies constitute just about 22% of the S&P 500 index. So this time around, it has gone far beyond that. And what we've really seen globally as well is that money is chasing these AI companies because obviously they are delivering very strong growth, even at the kind of scale that these companies are operating, and NVIDIA or a TSMC is operating. Even on that scale where these companies are growing at 25-30% because of the massive investments that are happening in the AI build out and the entire AI infrastructure ecosystem. Having said that, it has its own risk because now valuations in that ecosystem are very rich across the board, but the growth still continues to remain resilient. But we believe that we are in a very matured stage of this AI build out, or as far as valuations in stock markets are concerned, are ascribing to these AI companies. And to some extent, these valuations do look far-fetched or very rich in that context. Meaning, if you look at OpenAI at $500 billion of valuations, this is the highest ever valuation that any private company has ever seen in the history of the world. And that is for a company which is doing revenues of under $20 billion. So obviously valuations are extremely rich, but having said that, that momentum continues. But we believe one should be very careful or cautious in that context. And more importantly, one of the reasons that India has seen outflows from foreign investors is because India does not have AI companies or AI stories. So money has been taken out of India and has been rechanneled or redirected into companies, into AI companies, and has gone into countries which have those AI stories. So India has been at the receiving end of that whole spectrum in that extent. Another key highlight of the last year 2025 was was given the fact that Indian economy started with strong headwinds at the start of the year in terms of we were in the midst of a cyclical slowdown. The government of India was very focused on arresting the economic slowdown and probably putting the economy back on growth path. As a consequence, government has infused significant amount of fiscal stimulus into the economy, and RBI has done its bit by infusing significant amount of monetary stimulus as well in the economy. Last year started with tax cuts of around 1 lakh crores or about $12 billion announced in the budget, union budget last year, and government followed it up with GST cuts towards the end of the year. And between all of this, RBI cut rates by 125 basis points. So we've seen almost about $50 billion of fiscal and monetary stimulus that's been infused into the economy last year. And we think that will continue during the course of this year because I think the government is really concerned and focused on, while the economic decline has been arrested and the economy is stabilized, but for economy to gather momentum, I think the government will have to keep stimulating the economy, and which is where my base case is that, one, I clearly see another 25 basis points of rate cuts in March from RBI. And secondly, I see the government will continue to press the pedal on fiscal stimulus in the economy, and I would expect something out of this union budget as well. So I think the story of stimulating the economy to revive growth and accelerate our growth will continue during the course of this year, and which probably gives us some more comfort and confidence in terms of the growth recovery in the economy going forward. Having said that, we should be mindful of the fact that we are now getting into the 7th year of this bull market. All of us know that this bull market started in the midst of COVID lockdown in March 20. So we are close to now finishing 6 years in this bull market, and valuations are now pretty rich in the context of where we are in the cycle. And at this point of time, if you look at from a top-down perspective, India's aggregate market cap to GDP is at about 130%, which is obviously pretty steep and probably the second most expensive market in the world outside of US. So we should be mindful of the fact that markets are priced to perfection, and their pockets of markets of valuation are rich. So while the outlook continues to remain positive or optimistic, but at the same time, it's very important to be very careful and cautious in terms of what one is buying, because valuations are not comforting. Valuations are at the upper end of the curve that they have been. And more importantly, as I said, when you look at the dispersion of valuation, what we clearly find is that the mid-cap index is trading at premium to the large-cap index, and the small-cap index is trading at a premium to the mid-cap index. So while we have seen some narrowing of growth premiums or valuation premiums between the mid and small cap versus the large cap during the last year, but I think that trend will continue during the course of this year, where the growth premium or the valuation premium with mid and small cap have enjoyed versus the large cap will keep narrowing during the course of the year. So one should be mindful of this in terms of overall direction and trends that are playing out in the underlying market as one positions oneself for one's portfolio for the year going forward. Having said that, I think one thing which has really stood out for India clearly now that if we see is in the last 10 years, if you see the last decade or the last 10 years, India's macroeconomic fundamentals have been very, very stable. Last year has been a year where the world has faced significant amount of geopolitical headwinds and uncertainties, given the tariffs and geopolitical wars that have been around in the world. And India has had its own share of economic headwinds in terms of the now excessive tariff that India has that are being imposed by US on India for the time being, at least until we get a trade deal. In midst of all of this, Indian economy has still been very resilient, and what has really helped India in this challenging time has been India's macroeconomic stability. If you see over the last 10 years, India's real growth has been about 6.5% average, which is pretty good, and which definitely places us as the fastest growing economy in the major top 20 economies in the world. Inflation has been pretty benign and under check. RBI has done a pretty fantastic job in terms of managing inflation around 4.5% average over the last 10 years. More importantly, government of it has been very prudent in managing the fiscal balances of the economy, and average fiscal deficit over the last 10 years has been about 4.5%, despite the fiscal expansion that we saw during COVID. So, government of India has done a fairly good job in managing India's fiscal balances. And as a consequence, our forex reserves are more than doubled from where we were at $300 odd billion in 2014. We are now closer to $700 billion. And I think markets have clearly taken a cognizance of the very steady macroeconomic or stable macroeconomic fundamentals that India as an economy presents, and the strong growth, underlying growth India has delivered in the last 10 years. And as a consequence, markets have gone more than 3x, doing about 14% CAGR over the last 10 years. So I think India's macroeconomic stability, the resilience of Indian economy really stands out in an environment like this, where the external world is challenging and volatile, and probably will continue to remain so in the year going forward. As I have said, there's been a downward shift in India's growth about 6 quarters back. For the last 6 quarters, India is about a 6.5% growth economy, and we believe that India is a very stable economy, and probably India will continue to keep doing about 6.5 to 7% growth over the medium term. We're already 6 quarters into it, and we think over the next 6 to 8 quarters, we envisage Indian economy, growing somewhere between 6.5 and 7, which still places us, as I said, as amongst the fastest growing economy among the top 20 economies in the world. As I said, government of India has done a phenomenal job in terms of being very prudent fiscally. While we had a big fiscal expansion during COVID, which every country in the world did, after that we've done a significant or meaningful fiscal consolidation. Central government's fiscal deficit is just about, we are just 2 weeks from the budget, will be about 4.4% targeted budgeted levels for this year. And probably the government is committed to a path of further fiscal consolidation, getting it down to 3.6% by the end of this decade, which will put our aggregate borrowings at 50% of the GDP. So I think that's a pretty good job and very comforting. Inflation, all of us know, last year's story has been a significant downward shift in inflation at 1.5% CPI retail inflation. Probably the inflation is the lowest inflation that we've seen in the last 8 years. So, and that has opened room for RBI, window for RBI to significantly cut rates, which RBI did in the last year. And as I said, we expect inflation to continue to remain benign during the course of this year. And by the time inflation gets back to a lower end of RBI's corridor of 4%, I think probably towards the end of this year or early next year. So we expect inflation to continue to remain benign during the course of this year, friends. And that will provide economic tailwinds for RBI to inject further monetary stimulus into the economy. Given the growth slowdown that India witnessed in early part of last year, last year or CY25 has been a year of consolidation from a corporate earnings perspective. After very strong earnings growth, if you look at the top 200 companies of India in the first 4 years from outside of COVID, from CY21 to CY24, last year for calendar year CY25, corporate earnings grew at just about 2%. At about 4%. But I think the good thing is that the low point of this slowdown is behind us. We expect earnings growth to revert back to double digits, and we expect CY26 earnings growth for the top 200 companies and the Nifty companies to get back to about 10% this year and get back to mid-teens kind of a growth next year. So the good thing is, while we had deceleration in earnings growth or consolidation in corporates, profit growth last year in CY25, that is behind us. From here on, we expect earnings growth or profit growth to get back to double digit this year and mid-teens next year. Yet over this whole cycle, if we see from CY21 to 27, we still see that corporate earnings are growing at a pretty healthy 16%. So significant part of the gains that we have emerged in equities over the last 5 or 6 years, as you all can see, friends, have been supported by underlying strong growth in corporate profits, and which is what inspires confidence on the sustainability of earnings and markets over the medium term. I thought I'll place this in context. If you see over the last 5, 10, 20 years, Nifty has been a steady compounder. Last 20 years returns for Nifty has been about 13.3%. And last 5 years returns have been something similar at about 14.9%. So Nifty itself is a great compounder, so if you see from a long-term perspective, and over the last 20 years as well, Nifty earnings itself has grown at double digits or 10-11% over the last 20 years. So I think it's a very steady ship, and I think that reflects the both India is an ideal combination of one, long-term stability and strong and healthy growth over long term, and which is what really stands out for India. Having said that, last year was also a year where Indian markets were largely flattish at about, as we saw, 10% returns on the Nifty index in local currency, but in dollar terms returns were just about under 2%, and also was the year where India had the biggest underperformance versus its emerging market peers. So versus MSCI emerging markets, Indian markets actually underperformed by 30%. And this is the biggest underperformance India has ever seen in the last 30 years. The last time India saw such big underperformance versus all the emerging markets was in 1995. So obviously last year, a lot of money, as a consequence, foreigners have taken a lot of money out of India, and they've gone to other emerging markets which have done pretty well, the likes of Korea, Taiwan, China, and so on. Having said that, I still believe that India's underperformance has gone a bit too far, and there will be a mean reversion in this year. When you see such sharp moves from the mean on either side, my experience in markets tells me that you see a very sharp rebound or mean reversion also happening. And I think this year could be a year of mean reversion for India versus the rest of the emerging market pack. More importantly, in the context of what I said, that Indian economy has been a very stable economy over the last 10 years with very stable macroeconomic fundamentals, and that's now reflected in market behavior as well. If you see over the last 15 years, on a calendar year annualized basis, Nifty has delivered positive returns in 13 out of the last 15 years. So that's been a very healthy sign, friends, as you all see. And in fact, in the last 10 years, from December 16, CY16 to CY25, every year Nifty has given positive returns on a full year calendar year basis. So Nifty has not given negative returns on a full year basis in any year in the last 10 years. Now you can't ask for more, which effectively means that if you take last 10 years data, if anyone investing into Indian equities and staying invested for a period of 1 year, his probability of making money is 100%, because in the last 10 years markets have given positive returns year after year, every year. I think I can't, meaning this is one of the most optimistic or bullish data point that I have come across, and I thought I'll present this across to all of you all, that how stable and more Indian markets have been, and probably that will inspire confidence amongst investors to stay invested for a long period of time, because these markets on a full year basis are delivering positive returns. As I said, the story in Indian markets has been foreign investors have been sellers. They've sold $19 billion into Indian markets last year as well. Foreigners have been repairing their position in India for the last 3 years. As a consequence, foreign ownership of Indian markets, which was in the early 20s at 21-22%, is now down to about 15%. So foreigners have reduced their exposure to India by almost about 6% in the last 5 years. Which is both good and bad, because the good thing is that all those flows have been absorbed, or the supply has been absorbed by domestic institutions, including mutual funds, financial institutions and insurance companies. And given the fact that India is accumulating a significant amount of savings every year, and it's a very young democracy, which effectively means the savings will keep increasing every year, there's no reason why we should not expect these flows to continue on a sustained basis over a long period of time. And secondly, given the fact that foreigners have sold so much, the overweight on India is reduced significantly, which effectively means it creates room for in their portfolio, that when India comes back in flavor, they can have significant headroom to come back and add India to their portfolio. And more importantly, in that context, just to put in context, see, last time foreigners put money in India in December 21-22, India's weight in MSCI emerging market was just about 8%. So effectively, for every $100 coming to MSCI emerging market, India was getting about 8% share of the flows. While India has not done well last year, but India has done pretty well over the last 4 years and 5 years. And as a consequence, India's weight in MSCI emerging markets has actually gone to 15%, which effectively means that now whenever money comes back to emerging markets, India will get almost 15% share, 2x the share that we got in 2022 out of every $100 coming into emerging markets. So which effectively means that whenever the tide turns and foreigners, global investors start investing back into emerging markets as a category, India's wallet share in those flows will be double of what it was last time. So we will get much higher flows from foreigners going forward in future than what we got earlier from them. To summarize all of this, friends, how are we thinking about markets? So this is a quick take on markets. I still think that this year will be a year again of positive returns on the Nifty index. Probably I believe index can comfortably do a 12-13% returns at the Nifty index levels. And while mid and small cap will underperform the large cap index, but stock selection will help us make money on the mid and small cap. One has to be careful in terms of what one is owning, and if you own the right stocks, there is still money to be made. Having said that, just to put in context our medium-term, long-term view, we still think that over the next 7 to 8 years, India will double the size of its economy to get to $8 trillion in terms of size. And in this context, we think Indian markets can comfortably do about 14% CAGR returns at the Nifty index level over the next 7 to 8 years. And these returns are pretty much in line with long-term averages for Nifty as well. Though there is always a tail risk that India can do better than this, but having said that, given the fact that we are forecasting over a pretty long period of time, we still want to be fairly pragmatic, and we don't want to be either overly optimistic or conservative either. And we think this is what India can comfortably achieve. So these are very reasonable and pragmatic assumptions or expectations one can have from India, and that would I think that still makes Indian equities a very compelling investment case or a proposition going forward. To summarize my aggregate or overall view on markets and the outlook for the economy, I think the good thing is that earnings downgrade cycle is over. We see Nifty earnings stabilizing and probably getting back to double-digit growth this year. Given the fact that Indian markets have been flattish over the last 1 year and have underperformed global markets or regional markets, the emerging market peers, valuations are now pretty at 20 times 1 year forward earnings. Nifty valuations are pretty much in line with long-term averages. And foreigners having sold significantly are now equal weight or underweight on India. And more importantly, while some of these other emerging markets have done well in the last 12-15 months, primarily driven by the AI companies that exist in these economies, including China, Korea, Taiwan, which India lacks, and which is why some of these other markets have been able to attract flows. But we still think that if one takes a slightly more medium-term view over the next 3 to 5 years and longer time horizon, then India is the only secular growth story in emerging markets. Every other market is cyclical in nature. And so as and when growth mean reverts or the world mean reverts, we think flows will come back to India and will come back very strongly, because India stands out to be the only secular growth story in emerging market. Everything else is cyclical, friends. Very quickly, in terms of, because I do get asked this question very often, in terms of how our portfolios are positioned in the context, or what are the sectoral views in terms of context of what we are seeing in the markets. So I thought will put this up for benefit of everyone. Clearly, as I said in the early part of the presentation, financials is almost 30% of our portfolios are into financials, and we like financials, Indian financials. We still think that value is one sector where valuations are at a discount to the index. More importantly, we find the balance sheet in India's financial sector is pretty strong, and the sector is coming out of a period of slow credit growth over the last 6 quarters. We see credit growth picking up. We've already seen early signs of that in the October-December quarter, and we see that building up further going into this year as investments in the economy pick up, and as private sector investments pick up, and also as consumer spends improve, both across, especially across durables and discretionary. We see a revival in consumer borrowing and credit growth in consumer sector as well. So financial is one of our preferred sector, and we have, meaning the largest sector in our portfolio. Apart from that, I remain fairly constructive on consumers as a sector. I am turning positive on consumer as a sector almost after a gap of almost 6 years. I see probably the worst, the low point of consumer slowdown that we've seen in the last 2 years is clearly behind us. October-December quarter, we witnessed a meaningful recovery in consumption, both across staples and discretionary, driven by the GST cuts. But in a lot of segments in consumption, the growth momentum is held through. And more importantly, we believe that during the course of this year, we will see incremental, stimulus, monetary and fiscal, being infused into the economy, and that will drive and sustain the consumption momentum. So we see consumption, consumer spends to sustain, the recovery in consumer spends to sustain and probably build on from here. Also, what we're witnessing is there is a lot of latent demand that exists in households, and as consumers' income levels improve, or as there is more stimulus that is infused into the economy, as a consequence, as households have more money in their hands, they want to spend that money to fulfill their latent demand. So we continue to remain constructive on consumers as a sector, both across staples and discretionary, and we have a meaningful part of our portfolio into consumer sectors. IT is another sector which I have been fairly constructive on. Last year, the sector did not work for us. The sector was almost down 20% versus Nifty index being up 10%. So there was a very big underperformance in IT on a relative basis, and absolute basis, the sector delivered negative returns last year. But I think the worst of underperformance of IT is clearly behind us. I think this year probably IT could be a outlier sector, because we see one, growth outlook for these companies improving. Companies already sounding that out. We see the macro environment much more conducive now that the hangover of the fear of tariffs on or adverse headwinds to IT sector growth being taken off or have subsided. And clearly now we are seeing, more importantly, what was feared earlier by a lot of people, that AI can hurt these companies. In fact, we always argued that AI will be beneficial to these companies. We are seeing a lot of large AI deals scaling up and getting to large sizes, and these companies being a big beneficiary of that. So now that AI is now that we are in the 4th year of the launch of AI worldwide, AI is now from a concept and a trial is moving to adoption and implementation stage at the enterprise level, and AI deals have started scaling up. As AI implementation gathers scale and momentum, I'm once again reiterating this. I've said this on multiple occasions earlier as well. Indian IT services companies will be a very big beneficiary of that, because when it comes to implementation, Indian IT companies dominate the global IT implementation market with over 60% market share. So Indian IT companies will be a big beneficiary of that. So we like IT as a sector, and we have continued to we have stayed put with our exposure to the sector. And apart from that, we always liked internet as a sector, because we think that's one sector which will continue to grow at a very high rate, 25% plus over the next 10 years in India. So as investors, we are growth buyers. We are always looking to invest into growth and high growth companies. So that's one sector which really fascinates us, and we have exposure across the internet companies in our portfolio. So that in a nutshell, friends, I'm preempting a lot of your questions on sectors, and I thought I'll place it up front so that you all know where our sector positioning is in terms of our portfolio going forward for this year, and where we see alpha or outperformance coming from. This is where we see all of that happening. Maybe a very quick, I think I'm already 40 minutes into the call, so maybe a very quick update on our portfolios, and then I can already see a lot of questions in the question box. So I'll try to take as many questions as we can cover during the course of this. So very quickly, friends, our FlexiCap portfolio, Indian X PMS portfolio, you can see the portfolio details here. As I discussed, almost 30% of the portfolio is into financials, followed by IT and consumer. Between the three sectors, we almost have 65% of the portfolio between these three sectors, followed by internet. You can see the top, it's a fairly well diversified portfolio across 11 sectors. You can see the top 5 holdings here on the top of this on the top table on the left hand side. It's a fairly diversified portfolio with about 56% of the portfolio into large caps, and balance evenly distributed between mid and small cap, 15% small cap and about 25% mid cap. The portfolio has about high teens earnings growth for FY27, 16% earnings growth, and at about 18 times 1 year forward earnings, the portfolio is about one peg or close to that. So portfolio has earnings growth somewhat ahead of the Nifty index, and valuations are at somewhat similar to, also somewhat lower than the Nifty index. So we think portfolio is poised for a mid-teens to high-teens kind of a returns over the next 1 year. Last 1 year has been CY25 was a year which was a bit of a challenge for the portfolio in terms of performance, but yet despite that, if you see over the 3 years, the portfolio has done a pretty healthy 19.8% CAGR over the last 3 years, and 5 years the portfolio has done 28.6% CAGR. More importantly, even over 7 years ending December 25, the portfolio has done 19.5% CAGR returns. And mind you, friends, the 7-year returns takes into consideration a COVID crisis during which the portfolios did fell 30%. So despite some underperformance in the last 1 year, the portfolio has done pretty well across 3 years, 5 years, 7 year cycle. Last year was a year where we had exited momentum, most of momentum stocks from our portfolio. And as our core DNA is, we are growth bias and we want to buy growth at value prices. So we are value investors at the end of the day. So we have moved our portfolio by selling a lot of very expensive stocks and sectors, and selling a lot of momentum stocks somewhat early in the cycle, and bought into a lot of values like IT companies and consumer companies. While they did not do well last year, we think those companies, same set of companies, will do very well this year. So we clearly, as investors, we tend to sell into momentum, because we don't want to own high PE stocks, or we don't want to play stock price momentum beyond a point where stock prices are very rich or valuations are very rich and much beyond their fundamental valuation. So we don't play that momentum, and as a result, last year was a year of readjustments or consolidation for the portfolio, or repositioning the portfolio for the next 3 to 5 years, and which is what we've exactly done. So we think we have portfolios which are now fairly repositioned, fairly well placed for the next 3 to 5 years, and we have enough firepower in our portfolio to get back to our normal trajectory of high teens kind of returns over the next 3 to 5 years. Likewise, a large cap portfolio, all of you are familiar with Renaissance Opportunities portfolio. 70% of the portfolio is large cap, balance is spread across mid and small cap. Again, in terms of sectoral composition, is very similar. You can see the top 5 holdings here. The portfolio has about 17% earnings growth baked in for FY27, and at about 19 times earnings is about close to one peg. Similar story here in terms of performance. Over the last 3 years, the portfolio, despite being large cap, has done 17% CAGR, very healthy returns. Over the last 5 years, 19% CAGR, and last 7 years, again 16.7% CAGR. Very healthy returns across all time cycles. We've done the repositioning of the portfolio last year. I think this year we are again very well placed to get back to our trajectory of high teens kind of returns over the next 3 to 5 years. So last year we took a year as repositioning our portfolio, which we do once in every 5-6 years. Last year was that year, and now we are well placed for growth going forward. Very quickly, these are the performance numbers of all the 3 AIF funds. They are here for all of you all. I'm sure all of you all have it. So I'm going to move from this, but if you all have need any information, detailed information on this, please feel to reach out to our teams. One last thing I just want to bring it to notice of all of you all, as many of you are aware, we did launch our dollar fund out of Gift City in December last year. So now our Renaissance India Growth Fund, which is a dollar denominated fund, went live in 1st December last year. So idea with this fund is very simple. We think there is a significant amount of money that is there outside of India, and investors want to participate into India's growth story, and this fund provides a vehicle for that. So it's a dollar denominated fund based out of Gift City. So investments in the fund will happen in dollars, and the fund will be denominated, the underlying currency of the fund will be dollars. The fund is, the investment approach to the fund is very similar to our FlexiCap fund. It's a focused strategy with FlexiCap mandate, investing across large cap, mid cap, small cap. The underlying investment framework remains very same, focus on high quality growth companies at reasonable valuations, and it's a portfolio of about 30-35 stocks. So I thought I'll bring it to the attention of all of you all. The fund is already, as I said, live. It's just been about 2 months or 1.5 months into the fund. But anyone wanting any details about this fund, please do reach out to our team, and we'll be able to help you with more information. So with that, maybe friends, I've come to the end of our discussion. I can already see a lot of questions here on the chat box. So let me take those questions one by one, and I'll try to take as many of them as I can. The first question is from Nilesh Shah, and his question is: all metals, precious as well as base metals, are at lifetime highs. So view on their companies and also its impact on industries consuming these metals. Very interesting question. You're absolutely right. Precious metals is a different story. Gold is a different story because gold is a proxy, all of us know is a proxy currency given the geopolitical uncertainty that's going around. It's been now 4 years, we are into 4 years with the Russia, meaning we finished 4 years of the Russia-Ukraine war in February, and given the fact that the first time in the history of the world post World War II, Russian central bank's assets were confiscated by EU. Russian central bank had about $200 billion of reserves with European central bank, and they confiscated that, which has never happened in the history of the world. Obviously, central banks across the world in the last 5 years have been buying gold year after year. So there's a new demand, strategic demand for gold that has come in, new strategy, which is central banks across the world. If you see gold as a percentage of central bank holdings, which used to be like 4-5% 10 years back, is now low teens or mid teens for many central banks in the world. Having said that, I still think in the short term prices are a bit too far-fetched, and I think there will be a correction in precious metal prices because a lot of this is driven by short-term momentum or retail participation or frenzy, given the kind of frenzy that we are seeing in precious metal prices across the board. So I think some point of time there will be a sharp correction, and there's a lot of froth in precious metal prices. As far as base metals are concerned, one thing which is fundamentally changed now for the first time in the last 25 years is China year after year is reducing capacities of base metals across aluminum, steel and all of that. So while the demand is weak, but China is reducing capacity, and China is no more dumping metals into global markets. So I think that provides for a lot of stability for base metal prices. My view is that the metal prices will remain firm. So user industries will get impacted by higher metal prices going forward. I think this is a medium term trend. So that's the answer to your question, Nilesh. The next question I have is from Mr. Jai Kishan Kansara. And his question is, market is going up and even stable, whereas mid cap and small cap are brutally down. Is this the sign of next recession or new opportunities? So, Jay, I think that is the point I was making, that last year was a year where mid caps and small caps have underperformed large caps. More importantly, let me share one more data point with you. If you look at the breadth of the market, yeah, last year 68%, 60% of the, 59% to be precise, 59% of the stocks in NSE 500 gave negative returns. So only 40% of the companies in NSE 500 gave positive returns. So the breadth of the market did narrow down very sharply in last year, which effectively means that all the new money that is coming into the markets is coming into a narrow set of stocks. Yeah. And I think this, given the valuations are rich in mid and small cap, still they are still very rich compared to large cap. I think that trend will continue this year. So I still think that valuations will keep moderating in mid and small cap, and one has to be very careful, because in mid and small cap, because valuations are rich, wherever companies there's a disappointment in earnings, we are witnessing a very sharp drawdown in stock prices. So I think the breadth of the market will continue to remain narrow as it was last year. So which is where I think there is high degree of comfort in large cap from a valuation perspective, and mid and small cap be very selective. I still think money is to be made in mid and small cap, but not in every stock. For every one stock in mid and small cap that will rise, there will be two stocks which will fall. So only, meaning what I'm trying to say is only 1/3 of the mid and small cap stocks will make money for you. 2/3 will lose money for you, because valuations are very rich. So one has to be very careful and very selective in mid and small cap. I hope I have answered your question, Jay. The next question is from Kalpesh. He's saying, what are your views on IT and FMCG sector? I've already discussed my views across sectors. IT and FMCG, we are positive in both the sectors. I've already discussed that. So I think, Kalpesh, your question is answered. Kanan, Mr. Kanan has asked a question. Some underperforming stocks are in the portfolio, whether the stocks are kept for the long-term perspective. Absolutely, Kanan. Every stock in a portfolio is held with a 3 to 5 year perspective. While stock price can underperform for a period of time, and as you rightly said, some stocks have underperformed, but we still think that we have a positive view on these companies from a 3-year perspective, which is why we continue to own them, and probably at right point of time in some of those companies we can go and buy more of them. So for example, IT as a sector, we have a significant exposure to IT as a sector, and the sector has underperformed in the last 1 year or calendar year 25, but we have continued to own IT companies. In fact, we've added further to our IT exposure, because as stock prices have underperformed or stock prices have fallen, long-term fundamentals being intact, the valuation or the value in the stock has become even more attractive for us. As investors, friends, all of you all know, we are high conviction investors. So we will not hesitate from reflecting a conviction in a portfolio. So when we have a conviction in place, we will go and demonstrate a conviction. And every stock in the portfolio is a medium term to long term view. It's not from a short term. We are not playing any short term stock price trend or momentum, any of those. We are very fundamentally oriented value investors, Kanan. So I trust this answers your question. The next question is from Vikas. Do you see any big global geopolitical issue this year? And his second question is, how do you read US tariff policies uncertainty? What could be the effect on India? So Vikas, see, the world continues to remain volatile and uncertain. If at all, the uncertainties in the world have only increased. And my view is probably this is the new normal. We'll have to learn to live with this, because given the fact that it's the first time after World War II, I am witnessing that the world is in the midst of geopolitical and economic war at the same time. All of us know the wars that are playing around in the world. Iran issue is still not settled. Started with with Gaza in 2023. It's been now 2.5 years, and the issue is still not settled. Russia-Ukraine war continues. We've seen what recently US has done to Venezuela and the other troubled pockets of the world. So I think the world will continue to remain geopolitically volatile. When the largest economy in the world, which is 30% of the global GDP, when it imposes unilateral tariffs on every other trading partner, economic partner in the world, or every other economy in the world, this is nothing but an economic war. So the world is in midst of geopolitical war and economic war at the same time. This has not happened. I have not seen that post World War II, where both of them are happening simultaneously. I'm saying this is the new normal. This will persist for the near term, medium term, and we have to learn to live with this. Unfortunately, as far as tariffs are concerned, India has been at the receiving end. Now, India and Brazil have the highest tariffs in the world from US at 50%. Even Chinese tariffs are lower than that of India. So, obviously, it has impact on India, both from a trade perspective. It has impacted India's exports, and some labor intensive industries in India like gems and jewelry, textiles have been very badly impacted. The kind of unemployment that has happened because of this in the textile and gems and jewelry, and these are large employment sectors in India, is very significant. At aggregate level, India can still manage this because India is a very resilient economy. So yes, tariff has had a negative impact. I think all of us are looking for a trade deal. I have no idea when that happens, but trade deal will be beneficial for India and will take this hangover over. But for the timing, they do have a negative impact on India. So Vikas, yes, that's true. But the silver lining is, in midst of all of this, India is still doing 6.5% growth. Yeah, and Indian economy is still very resilient. I think that's the key thing that really shows the strength and stability of the Indian economy. Okay, let me move to the next question, friends. The next question is from Mohan Ji. He's saying, what's the earnings growth estimate for Nifty mid cap and Nifty small cap index for FY27 and FY28? Mohan Ji, the earnings growth for mid and small cap as forecasted for the next 2 years is around 20% CAGR. So it's much higher than the Nifty index. But the point is, within that, there's a very wide dispersion. There are companies which are growing within that at 30-40%, and there are companies which are growing at at mid-teens or low-teens kind of a thing. So the aggregate index earnings do not give you a complete picture, because in mid and small cap it's more stock specific. So one will have to get down to the stocks to take a broader view, because the dispersion will be very wide. Having said that, all this high growth is already priced into these mid and small cap or many of these mid cap small cap companies, because you still have a lot of mid and small cap companies which are trading at 40-50 multiples. So when a company is trading at 40p, effectively, even if you give it 1.3, 1.4 peg, you are baking in 25-30% earnings growth in that company for the next 3 to 5 years, next 4-5 years. So a lot of high growth, while forecasted growth is high, but these are already priced into the stock prices. To that extent, despite high growth, one has to be mindful that valuations are rich, and one has to be careful. Time and again, I am trying to sound out to you all friends that markets will do well. Be very careful in mid and small cap. That's the underlying message that I want to communicate to all of you all. Yeah. The next question is from Shri Narendra Ji. He's asking, what is the kind of returns you expect in 2026, and how will US manage its debt to get back to growth trajectory? I've already said that in 26 we're expecting about double-digit 10% growth in CY26 for the Nifty companies. So that's our growth expectation. I think US debt, is not such a big concern for the world at this point of time. If you look at the government debt in US, the sovereign debt in US is about $30 trillion or $32 trillion, which is about 100% of GDP. So there is history in the world where a lot of countries have had debt much higher than that. Japan runs a debt which is much higher than that. Okay, and US is a sovereign currency. Let's not forget that. So it does create long-term challenges for US, but I don't think so that's a big hangover from an equity market perspective or from a US economy perspective. US is still doing about 2.5% growth, as we've seen last calendar year. So the growth in US still continues to remain fairly resilient, this thing. So while I understand that there's a lot of narrative about this whole US debt and all of that, but I don't think so that is a concern for US economy or equity markets worldwide at this point of time. It's a bit too far-fetched to think about that, Narendra Ji. The next question is from Karthik Malhotra. His question is, with net imports, government expenditure and private capex expected to weigh down economic growth. Okay, in FY27, what do we take comfort in forecast of markets to post 14% EPS growth? Well, Karthik, I still think that government expenditure is not slowing down. Government will still, we are 2 weeks from the budget, but it's reasonable to expect that government expenditure will grow at 11-12% in nominal terms over the course of next year. So I don't see any slowdown in that. Private capex, while it's been what I would say is somewhat moderate or feeble in this cycle, but it will sustain at this level. If at all anything, it will improve from where it is. So I don't see that as headwind. There is some headwinds on export side because of the tariffs we have from US, but outside of that, public investments and private investments continues to remain fairly strong. And consumption has been slow in the economy, which I think after this stimulus that we've seen last year and probably some more stimulus coming into this year, we'll see a recovery. So on balance, I still think that the economy can grow at, as I said, about 6.5% next year in real terms and about 9.5-10% in nominal terms. If the economy grows at 10% in nominal terms, it's reasonable to expect that corporate earnings can grow at 11-12%. Though my outlook for FY27 is still about 11-12% earnings growth and getting into mid-teens earnings growth year after that as growth accelerates, as the growth momentum accelerates during the course of this year. So I think about 11-12% earnings growth is a reasonable expectation, Karthik, because government expenditure and private capex continues to remain resilient and consumption will improve, which has been slow or which was the missing link last year, will improve this year versus from the base of last year. The next question is from Mr. Prabhat Ranjan. Should I average in Gabriel India, KPI Tech, Tata Motor Passenger? Well, Prabhat, please kindly allow us to skip stock specific questions. Not possible for me to give stock specific advice. The only advice is meaning, so difficult for me because of compliance reason to give talk views on specific stocks, Prabhat. I hope you will appreciate this. The next question from Mr. Sumit Sharma, view on silver in near term. I don't have a view, Sumit. I wish, agar aapka view to aap mujhe bata do. I don't know. Silver is on a fire. I have no idea what's driving that. So, and I'm not an expert either. All I can say is I have zero exposure to any of these precious metals. So, yeah, that is where it is. The next question is from Shri Kalyan Reddy. Sir, your views on consumption. We are seeing a shift in consumption pattern of India towards mobiles, auto and real estate. So, Kalyan, as I said, I continue to remain fairly optimistic on consumption recovery in Indian economy, first of all. I think we'll see recovery across both staples and discretionary. You are right. What has really happened in India and across the world is post-COVID, the economic recovery in the world, not only in India but across countries in the world, has been a K-shaped recovery, where people at the upper handle of the K have continued to do well. The middle class and the upper middle class and the ultra high net worth families or the affluent families have continued to do well. On the other hand, people at the bottom of the pyramid have got really squeezed because the income levels have not increased as meaningfully or significantly, and inflation post-COVID was pretty high for 3 years out of COVID before it got tamed down last year. So that has really eaten into their purchasing power, really hurt them and eaten into their purchasing power. So it's been a K-shaped recovery. So while the what are you saying in terms of expenditure on automobile, mobiles, real estate, these are all discretionary consumption. The upper middle class and the affluent class will continue to spend on that, and they'll spend more and more on that. That will do well. But it is also my view that now we've reached a stage where we'll start seeing recovery at the bottom end of the consumption pyramid also, and which is where I think staples will also do well. The worst is clearly behind us in terms of growth for staples as well. So I see a recovery on both sides of the consumption spectrum, Kalyan, in that context. Friends, we already passed 5 o'clock on the clock. Maybe I'll take this one last question, and then if you'll have, I can see some more pending questions, but we will answer these questions through you on email, and if you have more questions, feel free to write to us and probably someone from our team will definitely answer that. The last question I want to take on this call is a question from Ishwar, which says, what will be your preference this year for PSU or private banks? Okay, good question. Well, our preference always because we are slightly more longer term investor, our preference always is for private sector banks. But PSU banks, I see some, value valuation uptake or re-rating in PSU banks this year, because there quite a bit of expectations in terms of reforms in PSU banks, in the banking sector, in the state-owned banking sector playing out this year. There are a few things that are lined up this year, and the expectations are pretty high from the government. One, clearly, it seemed from what we understand is the IDBI bank divestment is in the very final stage and should go through sometime in April-June quarter this year. So that will be a very significant thing. After a very long time, we'll see government actually selling a public sector bank. So I think that will be a significant, and if that happens, then that should act as a trigger for unlocking value in state-owned banks. Apart from that, from a regulatory perspective, the government has been talking about further second round of consolidation in state-owned banks, from bringing down these banks to about 4 or 5 large banks from about 15 odd banks that we have today. So I think if that is being announced, that will be again be a positive trigger for state-owned banks, because that will make this the 5 banks very large banks in that sense, and that will be a positive trigger for the sector. And also government has been seized of the fact that FI voting rights in banks are capped I think at 20 odd %. So while FIs can, even if they have more ownership, they cannot vote on more than 20% of their holdings. So that cap, government is talking about removing that cap on FI voting rights. And that will be a significant change, because a lot of global investors do not invest into state-owned banks because they do not get equivalent voting rights, which is a very essential right of any shareholder in any corporate structure. So if that is removed, then that will also give a very strong message to investors globally that the government means business, the government is open to reforms, and if they are shareholders of state-owned banks, government wants to give them a rightful ownership and voting rights commensurate with their shareholding. So I think quite a few things are lined up for state-owned banks, and if these reforms are carried through, then there could be a round of re-rating that can happen in state-owned banks. So we do own State Bank of India, and we have some other PSU exposure within the financial sector. But I think there is a valuation uptick or repricing that can happen in PSU banks this year. So with that, friends, we already 5 minutes past 5 o'clock. So let me call a close to this webinar. I really thank all of you all for taking a valuable time out for this discussion. I guess I tried my best to answer most of the questions. I understand there are still some more questions which are unanswered. We'll definitely reply to them. And if you have any more questions, please feel free to write to us, and we will definitely reply to that. With that, maybe I want to thank all of you all for taking a valuable time out for joining for this discussion, and wish all of you all a very happy new year for 2026. Thank you very much, friends.